Surviving Bitcoin's resilience through time. The future life expectancy of an idea or technology is proportional to its current age. The longer something has been around, chances are the longer it will survive. The Lindy effect. Fear and doubt. Bitcoin's history of uncertainty. As the original crypto, Bitcoin faced the brunt of negativity levied toward the digital asset sector in the early days. From doubts about the tech's capabilities to fears of Bitcoin empowering criminals, the FUD was real. Ultimately, every burgeoning asset class must traverse the 4 phases of mass adoption, traversing its share of criticism along the way. Bitcoin endured and set the stage for its successors. Concerns of legitimacy. Powered by Bitcoin payments, the Silk Road launched in 2011 as a marketplace for illicit contraband. Also a vector for white-collar crime, many used Bitcoin and crypto to push elaborate Ponzi schemes like BitConnect and OneCoin. Though criminals are often among the early adopters of novel tech, Bitcoin suffered PR damage for its early ties to malicious actors and entities. So even to this day, there are still people, some folks, and it's dying down, who are hesitant about Bitcoin and cryptocurrency because of its criminal nature. I mean, even as recently as 2021, there are still claims being made that the majority of Bitcoin is used by criminals, which just is not the case. And the reason that's such a prominent outlook is because of things like the Silk Road, right? In the early days, Bitcoin was definitely used by criminals, but that's history lesson for you, because every time a new technology comes about, some of the earliest adopters of that technology are criminals. And part of that is because a lot of times people who are operating under the shadows, they are in search of things that can give them the one up on law enforcement or their combatants, their enemies. And so Bitcoin definitely served that niche. And then in addition to things like the Silk Road, there's also been events that have basically wound up with a lot of people losing their funds, losing their money. And so BitConnect was a really big one. And if you've never seen the little meme, it's this guy who's like doing kind of the pyramid, multi-level marketing kind of, hype at a conference, and he's screaming BitConnected. It's funny, look it up. But anyhow, it was a really, really big thing in 2017. And it ultimately got shut down in 2018 as it was discovered that indeed it was a Ponzi scheme, a pyramid scheme. And there was also this this situation with this coin called OneCoin. And I cannot remember the woman's name right now, but she ran off with hundreds of millions. It may have literally been over $1 billion because she basically told people that there was this coin that was going to be better than Bitcoin, this, that, and third. She got a lot of people to buy into it on some pyramid scheme type vibes. And then she just ducked off, faked her death, and ran off with the bread. So given this track record, it is understandable why there are some people who are hesitant to this day of trusting something like cryptocurrencies and Bitcoin, specifically because of its history. But just know, yes, these things have happened in the past, but it is early days. So as you see more banks step in, more institutions, higher credibility entities into the space, it's like direct, inversely proportionate. So as more legitimacy comes into space, there's less risk of things like these Ponzi schemes even flying, especially given that there are regulatory bodies in place now to sniff those sort of things out. So then the next issue is one of regulation or oversight or lack thereof. New assets are usually slow to gain adoption due to an absence of regulatory guidance. Though some may reject outside intervention, regulations ease the minds of users and encourage new compliant development. Unfortunately, lack of major oversight led to several exchanges collapsing and losing user funds. Notable events include Mt. Gox and Quadriga CX. So Quadriga was a Canadian-based exchange, and Mt. Gox was based somewhere, I think in Japan. It was somewhere in Asia. And basically in both events, what happened was that at the time, there was a lack of diversity of options in the space for exchanges that somebody could use to trade with. As a result, both of these exchanges, they absorbed a lot of value inside of the space. Having observed so much value, they're holding a lot of funds, holding a lot of Bitcoin. And in the case of both Mt. Gox and Quadriga, ultimately it resulted in a loss of $500 million in the case of Mt. Gox and about $200 million in the case of Quadriga CX. And the technicalities around how each of these exchanges lost user funds is different. In the case of Mt. Gox, it came down to more or less some technical issue, whereas with Quadriga, it was more of a absconding of the funds with the guy who ran it sliding, running off, faking his death perhaps, and that's how the funds were lost. So in either instance, it's similar to the concerns about the legitimacy. These kind of events are very rare to take place, are much harder to happen if there is sufficient oversight being executed. And the other side of that is simply when there is more regulation, or regulation is clearer in any asset class, especially a new one, it makes it so that new entrants are more apt to come into the space and build something because they know that they have clear guidelines. What they often want to avoid as any new startup is entering into a space where rules are unclear, rules are ever changing, and could put you on the wrong side of regulation or law, given how the wind blows, because there is that lack of clarity before you ever entered in. And once there is greater clarity, there is usually a surge in new products, new companies, new businesses, and services built around that ecosystem because there's greater regulatory clarity so that these companies know what they can and can't do from day one versus building like a Uber might do and then hoping down the road, like, okay, maybe forgive our trespasses because this was unclear when we began. Now, unproven technology. Though new tech often brings new challenges, some bugs are more impactful than others. In 2010, an overflow exploit created 184 billion Bitcoin, leading to a soft fork 5 hours later. The 2017 Bitcoin war over block size and transaction speed fractured the community, leading to a hard fork, which birthed Bitcoin Cash and Bitcoin SV, Satoshi's vision. Now, the exploit, that was kind of a crazy situation because obviously with a hard cap of 21 million, we're talking about 184 billion. Had that would have stood inside of the blockchain ledger and not been forked the way that it was, I don't think we'd be talking about Bitcoin right now. We might not be talking about any blockchains or cryptocurrencies in this moment had that event gone on unresolved. But Satoshi actually went in and made a soft fork of the code to fix that exploit. It was effectively, to my understanding, it was an issue with the way that the numbers flowed over. So basically, if you put in numbers that were too big, it triggered this overflow. And it was an exploit that one could use to manipulate and kind of game the system. And so he went in and made a change to the code so that couldn't happen again. And then all those Bitcoin that were minted just kind of poofed, right? But it was a soft fork. The Bitcoin war with the block size was a dispute inside of the community about how much data should be able to fit inside of an individual block on the Bitcoin blockchain. Idea being, if they increased the block size, it would be able to allow them to process more transactions, but then it would be harder for somebody to run a node. And there were other nuances to the discussion as well, how it affected transaction speed. But effectively, what wound up happening was a hard fork, similarly to the hard fork that came in Ethereum, only difference being this was a hard fork that was decided upon in the case of the Bitcoin fork to have the bigger blocks go with Bitcoin Cash, as it was aiming to be more of a transactional version of Bitcash. And then in Ethereum's case, they had the hard fork to fix an exploit that Bitcoin was able to solve through a soft fork. So those are some differences there.